Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
I'm here with Ted Oakley, the founder of Oxbow Advisors down there in Austin, Texas. Ted, thank you for joining the Contrarian Investor Podcast today.
Glad to be here, Nathaniel.
I'm glad to have you. And it's an interesting time in markets. And people sometimes listen to this podcast to get ideas of where to invest. But just as often, they listen to find out where not to invest. I have a feeling that today's podcast will be more of the latter example. So let's take it from the top. What are your views on markets right now, on stocks, and on where one could maybe invest one's money?
Well, Nathaniel, in our market letter we wrote the first week in January, we said that we thought that the markets would hit new highs in the first quarter, because when you get this close, there's always been around a long time, and momentum will usually push you into those new highs. And that's really basically what's happened. If you look at everything, it's almost 100% momentum. It's not anything else. So we thought that would happen, but we also thought that might be the high for the year, such that a lot of this stuff that we see underneath, sort of underground, underneath the top, is not that great. And so we, and the other side of that is that just, we can sort of tell, we don't time the markets particularly, but we know when we can't find things that hit our valuation screens. And so when the pickings are really slim like now, that usually means you're fairly high priced. Doesn't mean that we go all cash or something like that, but we've got a lot. But right now, I think people at this level would be wise to at least think about cutting back some and having a little bit of defense right now.
You mentioned some underlying things that you've spotted. Can you talk about that? Because there doesn't seem to be much, at least economically.
Yeah, well, there are things that people don't see.
Yeah.
That way, if you look at, there's different things, but if you look, let's take hourly earnings, for example. On the decline, our work per week is on the decline, which is not, that's a good indicator. Typically, if work weeks are declining, that just means that, business is not that good. And so we're seeing declining work week, declining overtime. We're also seeing on the other side, the consumer side, which we don't think they're in that great a shape. I mean, they're doing more borrowing. The credit card balances are up. Buy now, pay later up a lot. We're seeing auto payments are behind. All of a sudden you're starting to get that happening, and then you're getting credit card delinquencies the same way. It all fits together. We're not getting any pickup, particularly from the real estate business, because they're only selling brand new homes that are worth $300,000. That's not going to get you anywhere in the economy, I don't think. But so overall, and autos are not that great right now. So a lot of the sections are not doing that well. A lot of people are saying, well, if you look at the manufacturing area, ISM ticked up a little bit in the services this past month, but we just don't think we don't think it'll last a long time. It could, but it all depends on whether the federal government comes back and puts a lot more stimulus into the marketplace.
Yeah, I want to talk about the Fed in a minute, but to your point, we just today, as we record this on Thursday, February 15th, had retail sales come in much softer than anticipated in January. So do you think there are some cracks there in the consumer? Because the consumer has been very buoyant here ever since COVID.
They had money, after COVID, they had extra money that was given to them.
Right.
But then if you look at the last 12 to 15 months, they have extra money because they borrow it.
Mm.
Well, at some point in time, and it's sort of like, a lot of people talk about the Gen Z and maybe younger millennials where they call it sort of the doom trade where they can't buy a home, they can't do all the big stuff. So they say, hey, I'm gonna buy a watch, or we're gonna take a trip to Hawaii. They just spend it, is what I'm
Mm.
saying. And we see, and people wonder, I have people all the time tell me, hey, there's a lot of people in the airports, and there are. But then if you look at restaurant sales year to year, they're really down a lot,
Mm.
nationwide.
Mm.
And so I think, yeah, that's what I mean by underneath it
Yeah.
all.
Yeah. No, that's fascinating because that's the type of stuff that we would be looking for. Because I guess it's no secret that the economic cycle is kind of long in the tooth here, right?
Well, it is, and I think people probably underestimate how big the tentacles of commercial real estate are going to be. It just got started, really.
Mm.
So, you probably have 2 to 5 years ahead of you where there will be nothing but, they're going to, all of that stuff was, a lot of it, I should say, was non-recourse. So they're going to be going back to the banks and they'll resell, and we see a lot of that, but we think it's just started.
Mm. Mm. Is there a systemic issue there potentially with the commercial real estate and who's holding all the bags here?
Well, it would be with the banks.
Mm.
I'm involved in a community bank myself for 25 years, and so I know quite a bit about community banking. We don't happen to we have virtually no CRE, but but if you look at most banks, they do have
Yeah.
a good bit of commercial real estate. And what I'm noticing now about banks, say between 1 billion and say 10 billion particularly, is banks that I knew were good banks, but now they're either making very little money or making no money, or a few of them are losing money. And 10 years ago, they wouldn't have been doing that.
Mm. Yeah, that's all kind of not great, I should say. And we saw a sell-off last week in regional banks. They've since recovered a bit, but yeah, there is some noise there again after last year.
The problem for them, Nathaniel, was this: if you think about it, in 23, the rates were lower to start out with, and they went up higher as you went along. And so banks didn't have to pay the exorbitant rates they have to pay now for deposits. By the time you got to the end of the year, they had to pay it. And so that means that all of this year, they'll be paying the high rate, see? And that cuts your margins way, way down when you have to do that.
Yes. However, rates, and that is an area that can change.
Yeah.
And if the Fed cuts rates, and what are your views there? Because it's already been pushed back. Coming into the year, you had some people saying that January could be a rate cut, then March, and now after the most recent meeting and speeches, we're looking at May, maybe. So where do you view that when we could see rate cuts?
Well, I always like to say, Nathaniel, that we don't have any idea, but because nobody knows. And so here's what we look at. I'll just tell you some things we look at. And if you have unemployment at an all-time low of 3.2, just think about it like this. And then you're going to have the Federal Reserve come in and start lowering rates. That means that all of a sudden you crank the wheels of inflation back up again when you've already got unemployment. Nobody can hire who they need already. So if all of a sudden you push that out there, that's going to throw you in probably at least into a new round of inflation. If they don't wait till unemployment goes higher, I think they're making a big mistake there, because there wouldn't be any reason to lower rates if everything is okay at 5% or 5.5%, funds rate.
Mm. Yeah, okay. And you don't think that the Fed could, when they do cut rates, and yeah, you would need a slowdown in the economy, presumably before they do, that could help out some of the real estate issues and some of these other issues that we're seeing?
Well, they could, but think about it like this. If people are looking for, let's say they're looking for 3 cuts this year, that would take you down to 4% on the Fed funds rate. And that wouldn't lower your mortgage rates that much. It would lower them some, for example. That would help. but you would still be at a fairly, you're thinking, 3/4 or 1%, you'd still have a 7.5% prime rate. So if you're borrowing, that's not cheap money, not around now.
Yeah. Yeah. Okay. Well, that's the big picture. Now let's talk about some individual sectors here. And I'm assuming here, actually, I know from having spoken to you before that you're maybe not a very big fan of tech stocks and these magnificent seven or however many there are now. Maybe Tesla's been kicked out, but yeah.
Well, I wouldn't say we weren't a big fan. We've
Okay.
just give you an idea of the ones that we own now. And let me explain the difference between us and somebody else.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
We've owned Microsoft for 15 years. We've owned Google a long time. We've owned Amazon a long time. And what we've done all along as they've gone to higher prices, we felt like they were getting more and more expensive. We've cut those numbers back, okay? So now those are underweight from what a normal position would be. But we own those three, okay? It's not like we don't own them. But we don't own much of it. We're not like a lot of people that own, 40 or 50% of their portfolio in five or six stocks. So and then they could go higher. It's just that most of that group, really, whatever you want to look at, we feel like that most of the growth that people are expecting is already built into those stocks.
Okay. And by the way, is it a magnificent? How many is it now? Magnificent.
Well, I think it's 5 because Tesla is on the way down.
Yeah.
Apple, we think, is on the way down or will be. And we own a tiny bit of Apple left too, but we've recently sold some over 190. And it just looks like Apple is going to be following right in behind Tesla. To us, it does.
Okay. All right. So what does that leave? What are you a little more positive about?
Well, during the fourth quarter, you saw us buy some consumer staples, which we have not bought in years, by the way, I have to tell you. We bought Coca-Cola, we bought McDonald's, we bought 2 or 3 healthcare companies that we like, and Cigna and Elevant, those companies. They've actually done well. We were going for defensive names because they got really cheap in the fourth quarter. And then we added, and then most recently, because we think people are misjudging energy, for example, on the production side, we added EOG, which is a really, really good E&P company, and another company called Northern Oil and Gas. Both of them pay, by the way, with a special dividend, they both pay about 5%, which is something we like. And then we always own and buy most of the pipelines. If you look at our top holdings, Enterprise Products, MPLX, Energy Transfer, Plains All America, if you average those yields, they're right around 860, 850, 860. And most of that comes on a K1 like real estate. So you're not paying any current tax on it, which is meaningful to us.
Okay. Now, okay, so that's nice on the income side, but to have any kind of capital gains in these oil sectors, you would think you need economic expansion, right?
Well, either that or you have a situation where supply demand is really out of line. Yeah. I'll give you a really good example of that. 1977, the market peaked in January, actually January 2nd, and the rest of the year, the market went down all year long, and oil went up all year long. And what throws people on energy a lot is that it's not always tied to what the market's doing. There's other factors that can come into play. We happen to think what will come into play here is that on a supply-demand basis that, we're getting tighter and tighter and tighter, closer to where, it's 1 and 1. Now, people can say that may not happen, but we even see sort of a turn back on EV going back toward fossil fuel cars. And so, a lot of that will change, we think, but we don't think the world's set up yet to where you cannot own energy.
Yeah. And even if electric cars do prevail, You still needed something that generates electricity, and usually that's going to be tied to fossil fuels, unless it's nuclear or something, I guess. Okay, so
Well,
that's really interesting.
that for us, I mean, natural gas is really cheap, and that's another area where we think, it's $1.75 an MCF right now. It should be $3.50 or $4 just on average, just to average it. So you can see the upside of something like that. It won't go to zero, but it's cheap.
Mm-hmm. And then the healthcare, what's the view there? Just a defensive play?
It was, and they got cheap. If you look at those companies, they got cheap during say September through actually August, September, October. They got cheaper, and it was a chance to really add them in there. That's what we look for in screening companies is we look for what we think they can make the next 5 years. We discount that back, based on what we think inflation will be, and then we try to buy it under that. We try to buy it 15 or 20% under that number. And you can imagine in today's marketplace, there's a lot of small companies that have that, but not big companies. And so that's where we end up with that,
And you don't like small caps?
Well, I do sometimes, but not now. Those companies are having a tough time There's a lot of things going on with small companies right now. They just don't look like that's where you need to be.
So anything else that you could be looking to add here, or to existing positions that you'd want to add to at these prices?
Well, I wouldn't say add to any. If you look at us, we've had things like Visa and MasterCard, which we think everybody ought to look at those companies when they sell off. Don't try to run them down and chase them. But those are the kind of companies you can own for a long, long time, because there's not bricks and mortar. You don't have to worry about capital expenditures particularly. And we see the digital age of money continually working in their favor. So those are two stocks we've owned a long time. But as far as buying new things, the only thing they've gone up now, but the last things we bought were, Cigna and Elevance and Unilever and companies like that. And so we like that. And so that's what we would look at right now. I think there's companies getting cheaper and cheaper. They just are not cheap enough for us, I guess.
But it doesn't sound like you would buy any kind of sell-off in tech.
I doubt it. I'm not saying we wouldn't at all, but you're going to have more than 5% or something. You've got to have a number that takes their numbers, each company, and throws it into where, what we would like to see.
Right. Okay. Real quick before we take a break, bond market, views there?
Well, in a bond account right now, and I think where people are making a mistake is if you look at the bond market, the last 3 years, and I read this last week, that the last 3 years have been the worst 3 years cumulative of the bond market since 1876.
That's a long time.
I think people are a little confused on thinking that bonds will always save them. But for us, the rates are high enough right now that for us, why would we want to risk duration at 4.2 when I can get short here and probably do okay for quite a while at 5.25 and be, say, 24 to 36 months short to come in on the Treasury. On the municipal side, we're doing the very same thing. We're doing tax-free bonds. We're doing 2, 3, 4 year maturities. That's where we like it the best. I know people are chasing the bonds right now, thinking that the Fed's going to come in, but everybody right now, Nathaniel, is begging. Whole street is begging for a bond rally and a stock rally.
Yeah.
And it just doesn't look like they'll fit together like that.
Yeah. So there could be a decoupling here. You see, because the stocks and bonds have moved together for a couple of years.
They have, but I think when this market peaks out, which I think I'd be surprised if it doesn't here in the first half, then I think one of those things that will come out of that is things will slow down and the Fed will have to do something. So your bonds probably would do better. It's just that we don't want to play in that arena of 20 to 30-year maturity, because you've got to be very, very right there, or you will get hurt. And so it's easier for us to stay less than 60 months, and we'll get most of the yield curve that way. We didn't chase the bonds when rates went down, to nothing. we refused to chase it. We had some lean years. I'm talking about a couple of 1% years, but still we didn't see what made it up for us was 22 and 23, where we didn't have that paper, so it didn't hurt us.
Oh, wow. Okay. This is some really interesting stuff, Ted. Very interesting conversation. I want to come back and ask you some more stuff, including about you, about your firm, about some of the books you've written. But let's first take a quick break. If you are a premium subscriber, do not touch the dial, because you will not get the break. We'll be right back. In fact, we already are. And everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Welcome back, everybody. Here with Ted Oakley of Oxbow Advisors. Ted, this is the section of the show where we ask our guests to tell us a little bit more about themselves, how they came to investing in the first place, and how their career unfolded to where they are now. So please do tell us about that.
Well, Nathaniel, I'm probably like a lot of people in the country that are really blessed to be where they are at this stage. I grew up really poor, okay, and I mean seriously poor. And
yeah, I read you didn't have running water.
Yeah, we had an outhouse, and we were in the sort of in the hillbilly part of the Smokies.
Okay.
No, not sort of. We were, and and what happened is we had a well on the back, and we eventually, 5 years later, got indoor plumbing. But
what year was, sorry, I keep in, but how late was there no indoor plumbing in any parts of the U.S.?
I'm sure there's, it may be today. I'm sure that in the last, there's been a lot of that up until in the last 10 or 15 years. But I think a lot of people don't realize how poor people really live. And it's sort of removed, out of sight, out of mind. And so they don't have to think about it. But one of the things that does for you is, I started working at the first job when I was 6 years old. So I always had to work, and I knew I had to get educated. And I left home at an early age, educated myself. I was in the Army a couple years, and I got really lucky. I was living in Dallas in a fellow told me, he said, hey, look, because I love math and I love numbers, love finance. And he said, hey, I've got a friend at Merrill Lynch that I think if you went with him, he'll send you to New York. And that's what happened. That's here. I'd already been a lot around the world, really been in the Army a couple of years, but I went, that's how we got started. And then I learned a lot there. And I came back and ended up with a private company. We sold that company in 1983. And since that time, we've had a couple of partnerships that still go on today, Herndon Plant Oakley, and Oxbow is named after, I own a home in north of Jackson Hole for many years. And there's a place there called Oxbow Bend. It's one of my favorite places. And so years ago, I named it Oxbow. That's how we got that name.
Cool. And so, yeah, so then you've had this business since the 80s?
Yeah, we've been managing money. Well, I've been in the business for 45 years, but we had it was Oxbow Advisors earlier, and then we changed the name to Oxbow. But yeah, it's a lot of ways it's the same, but some ways it's really, really different than it was 45 years ago. But
Yeah.
I would say investor emotions, they never change.
Yeah. Yeah. That's kind of the reason behind this podcast, is that you always need to have the contrarian view in mind, even if you don't follow it, just to, even if you know it's wrong, just to keep it in mind. Yeah.
Well, I've always said to everybody, I don't, we happen to do what we do. We may not be for everybody. And I certainly understand that if somebody is a real aggressive and they like to really get out there and get with it like that, that's totally understandable. And I'm not saying that's not right. It's not right for us and the people we manage money for, but I'm not saying that may not be right for them. I'm not one of those kinds of people that thinks I've got a lot of friends that make money in this business a lot of different ways. And so I'm always open-minded to that.
Mm-hmm. Is the money management business, is this something that you would, if you were starting today, would you still get into it or not?
Well, that's a really good question that I have also pondered myself. I think today, okay, if I just look at the landscape today, for example, and I were a young person, I've looked around at that, and it's funny because I think real estate's really full, of people, and I think the finance business is really full of people, and so if I went into it, I probably would. I mean, I love the business. I'd do it if I didn't make any money at it. But to ask it where to go, if the problem about starting a firm, if your firm's big, is it takes you a long time to sort of make that happen. And today, a lot of the people in the industry, and a lot of the people, they really don't know much about finance, and companies. They know how to buy 10 or 11 or 12 sectors, exchange traded funds, that sort of thing. But if you get in and start asking them questions about income statements and balance sheets, well, they glass over. They don't know what you're talking about. But I think we will go back to that eventually. But that's if you ask me the question, would I do it again? I probably would, but I probably would do it a little differently.
How so? Just have more compliance and things like that, and more lawyers?
No, I would. I think what I would have done is I probably would have concentrated more on a little bit more sophisticated. I would concentrate more, like we work a lot with business owners that sell companies, and I started that back in 1985. And if I'd done it 10 years earlier when I got in the business, that's my favorite place to work, is work with business owners after they sold businesses, because we speak the same language. And I would probably done more of that actually at that time.
Fair enough. Okay.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
So obviously you've been in the investing business for a very long time, and I'd like to ask people who've been around for a while how they would equate today's market if obviously the short answer is there's no equivalent, everything's different, blah, blah, blah. But there certainly are maybe some parallels. And I'm curious if there's any, at any point that what you can compare this to, going back, I guess, to the 80s or even earlier.
Well, I can. I mean, if you looked at the early 80s, like 79 to about 83, 84, what happened was oil and gas was the hottest thing going.
Mm-hmm.
Every time some little company, Canadian or US, would go drill a well and people would put the info out that they had X amount of barrels, this stuff, it was so speculative. It was incredibly speculative. And a lot of people lost a lot of money after that because they speculated in that group. I saw in 1987, I saw people just get caught up during the year. I did a little study in the middle of the year with my group, and I said, hey, what are the odds if we're up 22% now or 23, whatever we were at that time, what are the odds of us making a lot more money than that this year? And they were pretty low. And that caused us to raise about 50% cash in 87, different time. And then what probably is the most, I'd have to say, would be the period of particularly early 99, say January 99 through the next 2 years. And that was a culmination of all of this speculative investing in the internet, and everything was the internet. I mean, the internet was going to do everything. And of course, I've got a list of over 300 companies that came public during that 5-year period that all went to zero now, okay? So, but they had .com on the end of their name, and you couldn't, at that time, you couldn't speak anything to anybody that would sober them up. I mean, it's like, I'm going to buy Cisco and Intel, and I'm going to buy those kind of stocks forever. Okay. But some way, and if you look at those companies, I wrote a piece in January of 2000. I listed 13 companies that were 74% of the S&P return in 99. Okay. And 2 of them went down 40%, 3 went under, and the rest went down 80 to 90.
Yeah.
Over the next 10 years. So now we're similar to that. You got, and I think we're worse than the Nifty 50 because we're now the Nifty 5 or 6, and everybody's concentrated in that one thing. And if you look at historically, it's a lot like the late 20s, and unfortunately, you don't have anybody around today to say, hey, I was alive in the trading during the 20s, and this happened in 29, and people just kept on borrowing money and buying stocks and doing sort of, it's a lot like that, I think, now. And everybody has the same things. And unfortunately, I don't think they're thinking about what happens if something goes wrong with all of that. Because I will tell you, Nathaniel, if you look overseas, everybody owns these same, 5 to 10 stocks that are in the S&P. Every individual, every time we see a portfolio come in here, they all own the same. Even though they've got exchange traded funds, they'll still own these 7 or 8 stocks over here. Every mutual fund, it doesn't make no difference. Value, growth, ESG, they all own the same ones, okay? So when you get a turn on that, that is going to be a hard turn to make because you're going to have too many people trying to go through that keyhole, and I just don't think it will work. That I'm just saying, from a supply to demand, that's where we are right now. Everybody, we've never, ever, ever been this concentrated in such few names right there.
Yeah, that's kind of interesting and quite scary.
But you can't get them to sell them. I mean, you talk to people that come in here and they've got a lot of Apple, they've got a lot of Microsoft, or a lot of one of these stocks, and they've made a lot of money in them. And if you say, well, why don't we take your cost out plus maybe 15, 20, 30%, we'll leave the rest of it. Don't want to do that. I don't want to do that because you know what? It's going to go a lot higher. Well, that's what they told me in 2002.
Yeah. Yeah, I remember that. I mean, I was there for, barely. I was a young guy, but in 99 or 2000.
The word then, Nathaniel, was the new paradigm.
Oh, yeah. Yeah. New economy.
New paradigm, new economy. And it was for a few years. But I compare the ARK funds today, for example. You probably, I don't know if you remember this. There was a group of funds called Munger Net funds, okay? And they made these unbelievable returns for a couple of years. And interesting enough, over the next 3 years, they lost all of it.
Yeah. Yeah. Well, yeah. I mean, although you could argue that a lot of that has kind of started to happen. I mean, if you look at somebody like, to name and bring an obvious name, Cathie Wood, she had bought all these hot stocks in 2020 and 2021, a little late. And, she still holds them and she's still doubling down. So, it hasn't been up in a straight line up like it was in the late 90s. I mean, it has for NVIDIA and the others maybe, but.
Well, Snow Timer one time told me when I was a young man in the business, he said, hey, look, if you keep on buying stocks and they keep on going down, you need to stop buying.
Well,
so if I were in those situations like that, I probably would stop buying to start with.
Yeah, I mean, eventually you would run out of money unless you can keep raising it from people, one would think. Yeah. Gosh, right. Okay. So, all right. Well, this is all quite enlightening. And so you're not quite buying a soft landing for the economy either, are you?
Well, it'll be hard to have, that's kind of an unusual word to say right there, but it'd be hard to have a soft landing because if you look at it, all these lag effects that we're starting to see now, all these companies that need to refinance now, they're starting to happen now. They were able to put it off for maybe getting the bank to go with them for another 6 months or a lender for another 12 months. Well, that's passé now. They are coming into where they're going to have to pay up. And I think that's what's happening. And you're getting to that point, and that's going to be a trouble for the economy, I think.
Okay. Wow. All right. Well, a bit of a pessimistic tone, but it needs to be said. And I'm glad that you said it.
I'm not trying to be so pessimistic in that I will tell you, we look at lower markets as opportunities. And we never get depressed during the low markets, really, particularly. We usually have a lot of liquidity and they become opportunities for us. And I think you have to manage money like that. You want to be looking for times when you can make. I wrote one of the books I wrote one time was entitled The Psychology of Staying Rich. And most people with over $1 billion usually have a lot of liquidity.
Interesting.
That's why they have it.
Interesting. So they aren't all levered up into real estate and things. That's what.
Not a lot of them. A lot of them they have enough liquidity to take advantages of lower.
Interesting. Huh. All right. Well, there you go. Very interesting. Ted Oakley, thank you so much for joining the Contrarian Investor podcast today. Very interesting conversation. In closing, maybe you can tell us how listeners can find out more about you, more about the firm, more about your writing. And I will put this information in the show notes. I know your website is oxbowadvisors.com, but where else can people find you?
Well, actually, that's the best place. We have a big YouTube channel, really.
Yeah, I saw that.
We're on Twitter and we do those things. But the best place is the website because, if you want one of the books there, we'll be happy to send it to you. There's probably 10 books there. And you can see, we're pretty transparent. You'll see our market letters. You'll see interviews we do, and sometimes we'll put out an interim letter about what we think's happening. So you'll get a good taste of that because we don't try to hide anything. I mean, our mistakes are out there. I'll put it that way.
Yeah, and you can subscribe so you get alerted to it when there's a new piece out.
Yeah, you'll see it.
Awesome. Yeah. Okay. Well, I'm certainly going to do that, and I would recommend that listeners do as well. And with that, we will close for today. Thank you all for listening. Thank you again to Ted. And we will speak to you again in a couple of weeks. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.